Time for Q&A from the last market outlook. Contemplating purchasing the Applied series before December 1st. I watch your weekly outlook, Q&A, and other videos for years now. I've used your content to conservatively apply options to my positions for income and acquire and sell stocks. I find trying to catch up each week, finding free time outside my job and with the Wall Street Journal reading, and your content will want to take advantage of the last week of the lower price of the Applied series for future. I understand the Applied series is meant to be a supplement. It's a long question, and for people who manage portfolios, I don't know if it's really meant just for people who manage portfolios, but okay. Would you recommend this as someone who does their own financial management part-time? Yeah, I think I would. Well, I guess I would have to ask more about, well, what do you mean by your own financial management? If you're buying, an ETF that tracks the market, an ETF that tracks bonds and passively holding them, then probably not. I understand you mentioned you would be grandfathered on the future content. That is true. Do you envision more than sector analysis to be added in the future for people who already bought the Applied series? You know what? As time goes by, I kind of add things opportunistically. So I am working on the industrial sector right now, durable goods industry and the sub-industry of machinery. But I took the last 2 days off to work on ABR. And we are going to, in this video, learn how to deconstruct a short report, because there has been two short hits on ABR this year. Actually, three. One was written in the summer in a little bit more of an intelligent way. I shouldn't say a little bit more. More intelligently than the Ninji and the Viceroy report. Ninji and Viceroy were just written by children throwing mud at the company. We're going to deconstruct a short report. So I thought, well, we're missing an opportunity here. I was going to ignore it, but we're missing an opportunity. So I do these opportunistic things from time to time. So the answer, will there be more added in? Yeah, opportunistically, as things show up in the market and I think, well, here's a good opportunity to learn something. For ABR, we're going to learn how to deconstruct a short report. In the process, we're going to learn a lot about CLOs and CLO management. We're going to learn a lot about credit facilities, especially credit facilities that involve term repos. We're going to learn a lot about bridge loans, and especially bridge loans for real estate, and what the CapEx reserve is and what the debt service reserve is on these loans. Surprise, surprise, they do come with reserves. So we'll learn a lot about certain parts of a balance sheet and certain types of financial assets. We'll learn how to deconstruct a short report, and we'll learn a lot more about ABR's model. So I look at that and I say, there's a lot that can be done all at one time. This should be up Wednesday night, which is today. It'll be up later on tonight or early in the morning the next day. I'm trying to get it done tonight because I have obligations all day Thursday. What I have found, I started with options, the applied options, because I think that options are a really underused tool for most retail investors who actively manage their own portfolio. They can do better if they use options. If they're doing what they're doing, but just overlay some option strategy, they can always do better. And then I was branching out into some other categories as well from there, trying to find exactly what this product was eventually going to be. But it wasn't until I started doing the understanding videos, understanding banking, understanding mining, understanding utilities, that I noticed that that's where the engagement is. That if you look at where all the views are, they're concentrated, like by far, in those videos. That seems to be the thing that is most desired. So I will continue with that. There are 163 sub-industries, so there is content for years to go through. My focus will be on the sector studies and in those kind of understanding videos, but from time to time there will be opportunities like this to say, look, I can combine a whole bunch of things all in one video. So yeah, there will be other content, but I'm probably going to stick to the sector studies and the understanding industries, electric, pharmaceuticals, semiconductors, electric utilities, oil and gas exploration. Those seem to, as I say, if you look at all the views, dominate. Not a bit. Like, it's not like, you look at the views on videos and they're up here. It's up here compared to all the other views. They shoot right up like that. If you look at the views, it dominates. I think I've answered that question. Let's jump to the next one here. Early view of your content from 16. Okay, that's just a comment. If creating a synthetic long has the same payoff no matter where the strikes are set, and the cost of the call decreases while the credit for the short put increases the further you go, without needing extra margin, then why would anyone do anything else than pushing the strikes as far in the money as possible? Put assignment. You're short the put. Well, it can be put to you because the further in the money you go, the put is made up of intrinsic value plus time value, right? The further in the money you go, the higher the intrinsic value gets, but the lower the time value gets, both as a proportion of the total premium and as an absolute dollar amount. Well, if the interest rate is higher on the notional value of the underlying than the time value, it will be put to you. So in high interest rate environments, you're more likely to be exercised on puts. So the deeper in the money you go, you might get something really deep in the money, and 3 days later, the stock is put to you at that higher strike price. Now, mind you, you got the intrinsic value for it, but it would be put to you faster. That's the risk. In low interest rate environments, it's not so. You have it there. The frequency of being put to is less. But that's the risk you'd be taking. Is there a way to calculate tangible book value per share for ABR? Yes, take their equity. Attributable to the shareholders. ABR reports on a consolidated basis. So you have to take just the shareholder equity attributable to ABR, take that equity and subtract out any intangible. Look at the balance sheet and just take the intangible assets out. So if you see any goodwill in there, take that out. If you see any other intangible assets, take that out. If you see, now our ABR is a REIT, but it does produce some forms of taxable income. So you may see a deferred tax asset in there. Take that out as well and divide by number of shares. And that's it. I think they mention their book value per share on the conference call every quarter. I think at the end, the Q1 conference call, it was like 12.47. The Q3 conference call was sitting 14. I think it's 14.90 something, in around there. Is the reason the curve is inverted due to the market's belief that interest rates will fall in the long term? Yeah. Expanding on this, since the longer end yields are from the on-the-run bond sales, couldn't the government set a higher floor price for the bond auctions? Not really. No. It's an auction. I mean, it's whatever the market, wherever it clears in the market, that's where it is. Will this impact money supply in some way? Yeah, floor prices, no. Also, for your applied series, is there a section where you teach how to value a company, a real estate asset, such as with cash flows for the next X years, then building a model from that? So that kind of thing is useful if you're an institutional analyst, because you do want to try to be as precise as you can. But for a retail investor, couple of things. You're never going to have the kind of information necessary to make those forecasts, because oftentimes you're going to need access to management to ask questions. You're not going to get enough from the 10Qs, the 10Ks, and the conference calls to get it done. You're still going to have questions. And it is, I find, a long exercise that if you're only going to do a 50% or 60% job, then what's the point? You're really just, having fun with yourself at that point. Whatever you arrive at will give you, you'll have this belief that you've got this exact number, and you don't. Most of what you're going to put in your spreadsheet are going to be assumptions upon assumptions upon assumptions, because you're forecasting. What growth rate are you going to use for revenues? What margins are you going to use? What expenses are you going to use? What's the inflation component associated with those expenses? What is the likely strategic action that management's going to take in terms of managing efficiencies, in terms of CapEx? How's it going to fund its CapEx? Is it going to maintain a capital structure? Like, there's a lot that you would have to go through to break down. If you're heading to an institutional job, then yeah, you want to know that. For retail, managing your own money, it's a huge investment of time. And being that you can't do the job 90% or 95%, but only 50 or 60%, what's the point? I wouldn't get too involved in that. But the short answer here is no, I don't really have that in there. At some point, I will put a financial modeling module in there, probably using a real company, but it would be just a basic model. It's certainly not going to be, what you would expect to find somebody who has 10 years of industry experience in this company. They've had 10 years to refine and update and add to their model. I don't know that they're very useful, to be honest with you. Agency raised $432 million in the latest ATM offering, ATM at the market. Their holdings of MBS also increased by almost $9 billion. TBA portfolio reduced by $8 billion. Given that their repo agreements and other debt have increased by $5 billion, we would expect to see their credit facilities increase, the use of their credit facilities increase as their assets increase. That is natural. Could that be evidence that management is getting opportunistic with the wild spread widening? Well, if you're raising $432 million and your assets only, your MBS only increased by 9. Oh, hang on, 9 billion. Sorry, 9 billion versus 432 million. I was going to say 432 versus 9 doesn't say much, but it's a B versus an M. I get it now. I'm having trouble really putting this apart from the 10Q. Well, we have a credit cycle, right? And when credit is expanding, interest rates are dropping, credit's expanding. As interest rates rise, credit contracts. So there's a credit cycle. We're over here. I think we're at the bottom of the credit cycle, especially the bear steepener we've had September, October. I think that really put in the bottom of the credit cycle. I was buying 25-year bonds at 5.4 or 5.5 on some zeros. Unbelievable. Why would you not load up at that point? Well, why? Right? So I think that was the bottom, and credit spreads, or at least I shouldn't say credit spread, the spread between the 10-year and an MBS right now is extremely wide, as evidenced by the spread between where mortgage rates are, the 30-year fixed and the 10-year. Why wouldn't you be buying agency at that point? You can't lose on agency. Your cash flow timing may be different than any other time, because prepayments would be slow. Your duration would be extended on these bonds, so they're more interest rate sensitive. But why wouldn't you hold them? I seem to think that that makes sense, but I don't know that I would be using that much leverage, because you're using SOFR as your cost of financing. The spread between SOFR and the MBS, I guess it would still be worth it. Yeah, I guess it would still be worth it to use that, but I don't know that I would be leaning into a lot of leverage until I saw the central bank begin to cut. Now, after the first cut, it's not as if they're going to go back up again. If they cut, it's typical to expect that, well, a few more cuts are ahead. As soon as they cut, that is where I would go in really heavy. But I'd certainly have exposure to agency at this point. But I wouldn't really bet big until I see the first cut. Once the first cut happens, these mortgage REITs will jump, and then they'll have some momentum going forward with more expected cuts. On average, how many positions do you have in your active equity? Well, I mean, I'm leaving Canada next Friday. So everything had to be moved into cash and treasuries to make the trip across the border. But typically, I'd say 20 is high, 5 is low. 10 to 15 I think is in an average market. If we're in a confirmed bull market, I don't think that you need to diversify. I think you can concentrate more on names you think will outperform. If you're in a sideways market, diversification matters. If you're in a short market, then you obviously would move your positions lower. So yeah, depends on what the market is. What has been more successful for you, macro thematic trades or stock specific trades? Well, this year, stock specific trades for sure. Macro sucked. But over the years, it's been more macro that has led to, okay, I want to be in this sub industry. I want exposure to this. Let me buy these companies. So, I've had bottom up picks that were a result of a macro analysis. So I don't know that I could break it down to one or the other. Is there a gross or net exposure you target? Not really. Not really. I don't short a lot. In bull markets, 90% of stocks go up. Shorting is a low probability game. If I'm going to short, it's usually to hedge, so it'll be at the level of the market. If I'm going to short, very rare do I short a stock. I'll lean more towards the options if that's what I want to do, if I want to short something. Not that I don't short, but it's rare. Would love to see you create a video or two about the best and worst trades so far in life. You know what? Anybody who is in this game will have a worst trade of the year. And probably several stupid trades each year and several really good trades. And the element in the really good trades, the common element, will be luck. That I was in this trade, it did really well. It did better than I expected, so I got lucky. And I was in this trade and it didn't work out. And usually the common element there is you broke your rules. Either your position sizing was too big or you didn't take the loss when you had a smaller loss. So your dumbest trades come from breaking your own rules, and your best trades come from a good mix of skill and luck. So I'd probably just leave it there that if you ask for anybody's best trade, there's an element of luck in all of it because the trade was better than they thought. And if you ask them about their worst trades, generally it was because they broke a rule. Do you think strong consumption we've seen so far this year could be attributable to the excess savings accumulated during the pandemic? Consumers being consumers, they tend to spend a lot of that stuff. I think that the strong consumption that we've seen this year probably comes from credit as well, because consumer credit has been expanding. And record employment. You give people paychecks, especially in the U.S. The U.S. is got probably on this planet the highest marginal propensity to consume. So that if you give $100 to a citizen in all the countries in the world, the U.S., the American, will have spent it faster and more of it. than any other. They're number one when it comes to spending money and not keeping any of it. They are number one. So I find it hard to see how we can't point to highest employment of all time. You give people money, they will go and spend it. The only way to reduce demand is not higher interest rates. I mean, you'll reduce demand for certain things, but then they'll just take their money and buy other things. The only way to really reduce aggregate demand is to separate people from their paychecks. That's the only way, is to not give them the money to begin with. So I think that the strong economy you've seen is a reflection of the strong employment and the absolute high marginal propensity to consume that exists. It seems these savings might have helped consumers not feel the immediate pinch from the increase in interest rates. So we say, here's the level of savings, and we attribute those savings to the household sector, as if the household sector broadly has those savings. But everything follows a power law, or what's called a Pareto distribution. And so do household savings follow that distribution as well. So if we think about a uniform distribution, this is the level of savings per household. And we get an idea in our head that it looks like this, so that consumers or households have a lot of savings. That is a uniform distribution. That is not a Pareto distribution. So let's break it down into deciles, with the top 10% here and the bottom 10% here. So that's the top, that's the bottom 10%. You would probably draw out something that looks like this. That is a power law. That is a Pareto distribution, such that the top 10% probably account for anywhere from 70 to 90% of all the savings. It's not distributed widely across the population, so that savings are being depleted doesn't necessarily mean that all consumers are drawing down on their savings. Keep in mind that that we have the highest level of employment. That's probably more has more to do with it. I've read these savings have been decreasing. And okay, so I have savings, however you measure these savings, and savings have been decreasing. What is also within the savings category is all the money that is sitting in registered accounts, whether it be 401s or some pension account. I don't know what the proper term in the U.S. For it is. Here in Canada, it's just an RSP or a LIRA, a locked-in retirement account, or a registered retired pension plan. And if I'm retired and I'm drawing down, savings are dropping. Well, you do have the largest cohort ever in retirement right now, which could have been from this part of the distribution in terms of who has the savings. So if we put it in terms of age groups, and this is 65 plus, it's probably them. So when you deal with aggregates, you lose a lot of the granularity that makes it important, because now you're dealing with aggregates and averages, average savings per household. And we think, well, okay, then households are spending down their savings. All households are spending down their savings, but that's average savings per household. Does not necessarily mean those are the households that have those savings. So I think it's more about employment. And not so much, so yeah, there are some savings that are being drawn down, but if you're giving people $2,000 a month 3 years ago, I guarantee you they spent $2,000 a month 3 years ago, that they didn't put it in the bank and say, oh, I'm going to spend this in 2023. I'll spend it over the next few years. No, they spend it all right away. I think that the savings are a function of a smaller group of households, and a function of demographics, and the spending down of it is a function of demographics as well. You believe that as this financial buffer reduces, the effects of higher interest rates might be more noticeable? No. No. During this whole process, of spending down savings. Consumer credit kept doing this. Now, if they were spending down savings, you think consumer credit would have done this until savings were spent down and then started to increase, but they weren't. So I'm, when you deal with aggregates again, it becomes hard to say anything more than something on average. But, averages are very flawed. All I'll say about our markets, I never remember a year where data has been so grossly ignored and just flat out wrong reactions. I guess like most other institutions in this country, increasingly more corrupt and less trustworthy. Well, I don't know what that means. Pushing back against your comment that SPX keeps getting more and more expensive as OEs are going down and the multiples going up. I would say longer term yields have been dropping by a lot. So discounting these future OEs back to today will give you a higher PV than it did some weeks ago. In effect, not making SPX more expensive, but maybe keeping it at the same level. Well, we use a PE. A PE is a particular ratio that we can then use, and whenever you're using ratios, you're engaging in relative analysis. So relative analysis says, okay, well, here's the PE of company 1, here's the PE of company 2, they're in the same industry. Just based on the PEs, we can tell which one is more expensive than another. Done another way, you can have a timeline and you can look at the PE over time. And we can look at the S&P PE over time, and you can sort of map it out and what it looks like, and you can have some kind of average level over a period of time. That all you can say about the PE, because it's a consistent measure over time, is whether or not we are more or less expensive relative to any other time. If you are trying to compare it with yields, the PE is the wrong thing to do. You want 1 over the PE, which is the earnings yield. Right? So you can look at the earnings yield and you can compare that, since this is the S&P 500, compare it against the yield you would get on investment grade bonds. The investment grade are anywhere from, well, they can be 10 years, 15 years, 20-year bonds. So look at a portfolio of investment grade bonds. What's it yielding? And look at the earnings yield you're getting on the S&P. Keep in mind that the bonds sit higher in the capital structure than the equity, so the earnings yield on the S&P must be higher than the earnings yield on investment grade. So at last reading, the PE was what? Call it 19. So 1 divided by 19 is 5.26%. Cash yields cash yields more than 5.26%. At this point. So you would compare that 5.26. Well, what can I get with investment grade bonds? And as interest rates drop, the value of investment grade bonds would increase. The value of the market would increase. So there should be some spread, some premium between the investment grade yield and the equity yield. And if you're not getting a premium, then either we're at the bottom of a trough in terms of the economy, and you have earnings, a market that is cratered, giving the appearance of the market being overvalued because it has a high PE. Oftentimes, you can get these kind of peaks are either bubbles or crashes. So let's say the market now crashes all the way down to 2,800. And earnings crash along with it. Well, you could end up having a very high PE on the market, but it's because on the economic cycle, we're down here and we expect really this to happen. Do you expect this to happen going forward? And usually rates are already very low at this point in time. It is a recession that usually causes the central bank to cut rates enough such that these valuations or the higher multiples are justified given the low interest rate environment. I don't see that we're here. We're at the bottom of a credit cycle. We're at the top of a tightening cycle. And for the last year and a half, the forecast of forward earnings drops through the earnings season. that when we drop off one quarter and add the fourth out quarter, we have a jump in the operating earnings, but then they decline from there. So this is not the environment, I would say, that justifies buying high PE markets because we're at the bottom of it. We're at the bottom of things. Earnings have not cratered at all. We're sitting at record earnings, record margins too, with labor really starting to bang the door. So we haven't even seen the effect yet of this cascading union effect that we're seeing every week. It's a new company going on strike, a new group of people going on strike. And those companies that don't have unions are looking at this saying, hey, we should get in on this too. How do we get in on the union bandwagon? Because margins, the share of national income that's going to labor has been dropping for quite some time. It's going to want it back. I don't see that we're in the environment that I would say that I would make this argument. But if you are trying to make the argument about the longer term yields, then compare the earnings yield, 1 over the PE, with what you get on IG. Agency, repo agreements. Investor buying the MBS will receive interest plus principal on the MBS, so the investor will make the interest spread. Seller of the MBS retains risk on the MBS and is committed to buy back in the future as a reserve value plus repo. Yep. So the price falls. Yep. You will suffer a loss. Yep. So normally how this works is the repos are rolled over so that you have continual repo financing. It's not as if, it's only for a period of time and then it's over. So let's take a 5-year period. And you will have a credit facility for repos, and maybe it's a term repo, maybe it's a 30-day term repo, 30 days, and then you do another 30, another 30, another 30, another 30, another 30, you just keep going. And as soon as one credit facility is done, you just roll it over into the next one. So you always have the spread. Now, if short rates are going up, then that spread gets worse and worse. But if rates are flat or dropping, then this starts to get more and more profitable, especially if these rates are dropping, because the bond you bought had a particular yield when you bought it. That yield stays the same, but your funding drops. This is a great environment for agency. But yes, there's risk. Like if you could buy a 10-year bond that's yielding 6% and lock in financing at 4% for 10 years, you're done. But you can't lock in 4% for 10 years, but you can lock in maybe a certain percent for 30 days, and then for 30 days, and then for 30 days, and you keep doing that. If you were 25, had student loans at 4 to 5% interest, would you pay those off? Or would you prefer making the minimum monthly payment, invest the difference, 80-20 portfolio? Well, in this interest rate environment, if you're paying 4 to 5%, you can put your money in cash and get 5.5%. So if you're paying 4.5% on your student loans, put your money in cash, get 5.5%, make the spread on it, and make the minimum payment. But when rates start dropping, unless if you have fixed rate on your student loan, then you're going to want to pay that off. If you have floating rate, well then I don't think it matters. I don't know. It would be a lot of assessing as to how much in student loans, how much is it? What options do you have available? Are you 80-20? 80-20 has risk, right? If you're going to have debt at let's say 4.5%, and you want to take money and invest it instead, then that's in essence a carry trade. Your negative carry is the interest rate on the student loan that you could have eliminated. So you got to make sure that you turn that negative carry into positive carry. And if you're taking on risk, you don't know if you're going to get positive carry or not. So I don't know enough about you, your risk levels, your risk tolerance levels, how much money we're talking about to be able to make any kind of choice. I myself, when I finished, I had student loans. I made double payments every month. I didn't make the minimum payment. I made double payments every month just to get it out of the way. I didn't want student loans for 9.5 years. I wanted them gone. I think I was able to get rid of them in less than 3 years. But I wanted them just gone. Do you think it is reasonable to diversify part of portfolio revolving around EV theme, having COPX and XLE? So copper and energy? Yeah, I do. I'd say that mix should have growth potential and stable income, relatively low risk. I agree. 60-40 portfolio. 60-40, or let's say 80-20 for a younger person. There we go. What do you think of using floating rate corporate notes instead of fixed government? Yeah, if rates were low and expected to go higher, floating rate. If rates are high and expected to go lower, fixed rate. You mostly refer to fixed rate government bonds as fixed income part of portfolios because you consider it the best diversification instrument. That's for a portfolio mostly consisting of equities. Well, yeah, it would. The floating rate bond will hold very close to par. So in a floating rate bond, you're getting income, but no capital appreciation. So it's not really a diversification tool against equities. You'd want duration. Now this is when the correlation between duration and beta was negative. It was a great diversifier, but for the last, I don't know how long now, the correlation between duration and beta has been positive. So it's not a diversifier, it's a multiplier. It just multiplies the risk that you have. It doesn't diversify. I don't expect that to continue. I expect that negative correlation to return, but it hasn't been very good so far. That over the last few years, the floating rate bonds would have been better. But again, rising interest rate environment, floating rate bonds. Falling interest rate environment, fixed rate bonds, because the duration will give you a capital gain. You mentioned once in the video that you did some day trading in the past, but do not like it because it is boring. It gets boring, yeah. Can you show us in the applied series how you do it? On what do you look, how would you manage the intraday? So yeah, I can show you how, but I'm not doing you any favors. It'd be like you saying, can you show me how to inject heroin just so that I know? You know, I can find you somebody who will explain it to you, but I'm not doing you any favors. It's better you just not know. Most 95% of people who start on the day trading path within 3 to 6 months are out of business. They're out of money. There's a reason why it's called day fading, and these are called day faders. They disappear. If there was an index, like if Robinhood could say, we've identified these 1,000 accounts as pattern day traders, the net asset value of these 1,000 accounts is 8.4 million, and we've created a security that allows you to short the value of their net asset value, I would jump all over that. I would short it all day long. I'd probably make a really large position on that because they all disappear. The day traders all lose money. Roughly the 5% that succeed, 4% of them probably underperform what they could have done had they just bought an equity market ETF and went away. They underperform but have the illusion that they're making money, but they're making a lot of short-term capital gains. And if the tax authorities determine that you are in the business of making capital gains, then they're not capital gains anymore. They're income, and you're taxed at an income tax rate, not a capital gains rate, which means their returns are extremely inefficient. And then maybe 1% actually make money. However, the amount of time they spend sitting in front of a screen chasing nickels around the screen, because that's what you're doing with day trading, to me seems like you could spend that time more productively and more profitably by buying an index ETF and getting a job, and then having an income, and then taking some of your income and dollar cost averaging that market ETF for the next 20 years. You do a hell of a lot better. Day trading comes down to this. It has nothing to do with you. Nothing to do with you at all. And it has nothing to do with the company that you buy. In fact, most technical analysts, the ones that exist, will tell you they don't even care what they're buying or selling. You could just give them a chart and say, here's a chart, and not even tell them what it is, and they'll trade it. Or at least attempt to trade it based on their signals that they particularly like. Most day traders couldn't tell you, if you say, this company here, what do they do? Probably couldn't tell you. Probably couldn't tell you what they sell, who the CEO is, are they cash flow positive, are they making money? They probably couldn't tell you a single thing about the company. And in their defense, it doesn't matter, price and volume. And then you'll have indicators, and all indicators, all technical indicators, 50%. Same with a coin toss. You could, if you have a technical indicator saying I should buy, flip a coin, it's the same thing. It's the same thing. But what makes day trading what it is that you have this firm rule that I'm going to take a 30-cent loss and I'm going to take a 90-cent take profit, for example. So you're risking, you'll risk, 30 cents to make 90, or basically you're going to risk a nickel to make 15 cents. So you only have to be right 33% of the time. So if you tell me this indicator is right 50% of the time and I have these rules, I'm going to make money, aren't I? That's it. There's your degree in day trading. Now go do it. That's all it is. So you need some indicators. Most will use 4 to 6 indicators. Whenever they'll create some kind of weighted index of this, you can create a diffusion index of it, and when it's over 50, that would mean that more indicators are suggesting buy than sell, and when it's under 50, more indicators are suggesting sell than buy, and then you simply trade that with these very firm rules in place. Take loss, take profit. That's it. Once you write the algorithm, you're not even needed. You don't care what the target is. You don't even have to sit there anymore. The idea of sitting in front of your screens with a bank of 6 screens with charts up and trade here, trade there, that's the movies. Okay, that's the movies. Day trading is really boring. It's a lot of trades, and when you put the trade on, it's always got a stop loss and a take profit, and then you just ignore it. Around 3:45, you look at how many open positions you still have, and then you start closing them because no overnight positions. That's the rule with day trading, right? You have no because you don't want off-market risk. You don't want a risk that something happens in the middle of the night because you can't trade that chart in the middle of the night. So you close your positions wherever they happen to be. Yeah, I can show you how to do it, but it's unsatisfying, it's boring, and at least I think it's boring. But here's the danger. You might actually like it, you might actually get hooked, and you will, over time, not you specifically, but there's a 95% probability that in 3 to 6 months you'll be broke. That's just the statistics. And I know what you're thinking. Not me. That was those guys. They're probably just a lot of stupid people doing it, but not me. I'll be different. That's what they all say. That's what they all say. Now, if they didn't say that, they wouldn't do it. They all say that. Everyone believes, oh, not me though. 95% odds against me, not me though. I'll be in the 5%. It's a brutally difficult way to trade, and it comes down to hard rules. Period. Hard rules. You can't care about the losses. And every time you take a loss, you say, well, okay, I'm losing nickels to make dimes. That's what you're doing. But yeah, I can show you how to do it, but I'll tell you straight up, I'm not doing you any favors by showing you how to do this. Okay, I already answered that one. That's a CFA question. GE is a diversified industrial. So it's kind of hard to get done because they're in a bunch of different sub-industries. So to do GE would be doing a whole bunch of sub-industries. But if I do machinery, you've got some part of GE done, right? Because GE has some divisions in that category. Do you think small to to mid caps look attractive? Not in a high interest rate environment. They're not going to look attractive until the rate cutting cycle begins. Over the last 20 years, the IWN is underperforming SPY by the same extent, only 3 times during this period. Valuation-wise, looks good, but my concern is maturing debt for the unprofitable companies will weigh down the index. Do you think active management and security selection has the potential to... Well, that last statement, I mean, the answer is yes. Do I think that active management and security selection for anything has the potential? Yeah, it has the potential. But that doesn't mean it will. Active management always has the potential to outperform. It doesn't have a good track record of outperforming. 80% of actively managed funds don't beat their benchmark after fees. After the cost of paying for active management, you would have done better just being in a passive vehicle. 80% of them have that problem. Just every year it's a different, the 20% that do beat are a different 20% each year. So it's not as if you can find a fund that can consistently do it. Most that beat in a year don't have consistency, that over a 4-year period they all revert to the mean. So yeah, you have the potential, sure. But let's just say something about that. The potential, if you're just underweighting and overweighting, that's a hard game to play. But if you're going to bring other strategies in, if you're going to use the options judiciously, then yeah, you could take a passive index without any active management at all, overlay some very low risk option strategies, low delta option strategies, 10 delta, 20 delta option strategies, and outperform. But you are stepping outside of the index to get that done, because the index doesn't have options. Is there a time, place to combine a current macro assessment and an allocation factory for a long-term passive position? I think it'd be foolish to sell puts on SPY at this level given its forward multiple. If it were to fall to 400, I'd be pretty comfortable there. Instead of targeting a specific delta every 2 weeks out, would setting a price target be reasonable? Well, listen, targeting a specific delta 2 weeks out is playing a probability. So if you are selling 10 delta puts, there's a 90% probability based on implied probability distribution that the stock's not going to be put to you, right? So you're not when you're doing the allocation factory, and let's say you are doing a low risk allocation factory at 20 delta or 10 delta even. On average, only 1 out of every 10 will be put to you. On average, only 1 out of 10, which means you're actually getting 10 premiums for every 100 shares that are put to you. So that's the part of it, is that you could do it at any time. And as the allocation starts to build, and you say, well, I want 1,000 shares, I'm at 300 now, and market seems kind of weak, then you can start selling calls against the 300 that you have. You can introduce 10 delta or 20 delta calls. But by doing this, you're playing on the moving average, not the daily volatility. So I don't know that I would wait for a certain price. That's confusing the strategies, right? Or is entering into a passive position really something I should have been doing yesterday? Look, we always think that we really should have started something. Well, if I would have started this a month ago. And then 6 months from now, you're saying, well, if I would have started this a month ago. It's just a matter of if you have a long-term hold, if let's say you don't need the money for 20 years, then what do you care what's going to happen in year 2 or year 3? You're really just concerned what's going to happen in year 20, and I'll tell you what's going to happen. Sometime in the next 20 years, this market is going to be much higher. Same with the value of houses. You don't want to buy a house now because you're concerned about a price correction, but you're going to live in it for 25 years. In 25 years, the value of that house will be much higher, period. But if you're concerned about your day-to-day NAV, then yeah, you're always trying to time the market. But if you have a long-term perspective, don't worry about your day-to-day NAV. Don't worry about that. Buying duration, replicating TLT. You mentioned the highest duration is 30-year zero coupon bond. Why is that the case? Well, because it only has one cash flow. So let me see if I can give you an example. Let's say you're looking at people who finish university. Some finish in 3 years, some finish in 4, some finish in 5. You would say, well, the average amount of time, the average time is 4 years. But what if I said, well, there are 10 people here, there are 20 people here, and 30 people here. The average isn't 4 anymore. You would have to weight it. You'd have to say, well, there's 10 over 60 that finish in 3 years. There's 20 over 60 that finish in 4. And there are 30 out of 60 that finish in 5. Well, what is this? This is still the average time, but it is the weighted average time, WA time, the weighted average time to graduate. Now I want you to think about cash flows for a bond. A coupon paying bond pays here, 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 and then there's a bullet payment. So if you're thinking about, well, what's the average time for me to get my money back? Well, you have different weights. So you would have to weight this coupon by the amount that you paid, P naught. This coupon by the amount that you paid. This coupon by the amount, and then this principal here by the amount that you paid. And then you'd come up with the weighted average time. Much like this is a weighted average time, this is a weighted average time. This is a weighted average time to graduate. This is a weighted average time to the receipt of your cash flows. Once you have, this is Macaulay duration. You divide Macaulay duration by whatever the cash flow yield is associated with these cash flows, and you will have modified duration. Now notice you had some weight, some weight, some weight, some weight, some weight. If you have a zero coupon bond, you only have one cash flow. All the weight is on the final cash flow, so the average time must be 30. Whereas here, because you have some other weights, the average time is something less than 30 if we were thinking about a 30-year bond. The average time is somewhat less than 30, but here the average time has to be 30. So you can have something, and they may both have the same R. They may both have the same cash flow yield, because if they're both 30-year securities, they would trade at the same yield, just one of them has coupons. They would trade at the same yield. Some of your yield here is coupon. Here, all of your yield would be capital gain. And so you can see that the duration here, because the denominator is the same, whichever has the higher numerator, this would have the higher numerator. That's an easy way to see why a zero coupon bond would have the highest duration. Curious what your current thoughts on ChargePoint are. Challenged, very challenged. The management team has been gone. I think the CEO is gone. Earnings, their guidance didn't come down a bit. It came down a lot. I think they went from like 160 to 180 million down to 105 to 110 million. Like that's, like less than it's more than, I think, 40% 40% lower. So not good. Guiding 40% lower on revenues and losing 2 members of the executive team. I think the CEO and some other person are gone. That's not good. So I don't think that I would touch it. Are you planning to bring back the interesting articles of the week section? I don't know that I had any plans to do anything really. I'm trying to coordinate my move out of the country, and it's extremely time consuming with everything I'm doing. That once I get settled in Costa Rica, then I can start thinking about what it is I truly want to do at that point, because I'm sort of reevaluating some things. I had fun with that one. And I do save articles during the week that are, you go, oh, this is interesting and this is interesting. I might just have another video that I do throughout the week, a 20-minute video or a 15-minute video saying, okay, these are 3 interesting stories I've seen. I don't know. All of these things take time, right? I follow small to mid-cap specialty pharma and biopharma. Identified a short candidate. Shares and options are thinly traded, but vol is relatively low following a big price spike on the back of some non-recurring earnings event. I want to take a short position with limited loss potential. Is a long put with 3 months out the best way to get this done? Well, if the stock is thinly traded, the options are probably going to have wide spreads and be thinly traded. You have to think about your ability to get out quickly. I mean, you can get into things. Getting out is sometimes the bigger problem. Bear put spread, do you ever simply short shares? Which metrics are you mindful when doing this? So in the portfolio construction module of the applied level, the last video I put up there was shorting a stock. The first thing you want to do before you short a stock is check the short interest and check the borrow rate. How much is it going to cost you to borrow stock? I showed the example last week in the video of using ABR. ABR's borrow rate was over 20%. If you wanted to short ABR, it would cost you 20% of the value, and it's a floating rate. That 20% borrow rate could be 30% the next day, then 40%. I've seen borrow rates 60, 70, 80%. So before you go shorting a stock, if everyone has the idea to short the stock and the broker has very little supply, you're going to pay a very high borrow rate. So you want to check that out first, and then make sure whatever options trade you get into, that the spreads aren't so wide that if you have to get out now, if you got to get out really quick, let's say they have something in phase 3 and they get approval for phase 3 and they go on the registration process, well, you're crushed. You would have, well, actually, if you're buying a put, you're not crushed. All you lose is the value of the put you spend. That might be the better way to go if you can get in there. What factors explain higher yields found on 20-year treasuries compared to 30-year treasuries? It's because there's really no use for the 20-year. So the 10-year is a risk management tenor. It's very popular for risk management, for adding or subtracting duration from portfolios. The 10-year is a very common thing to use. In fact, it's so common there's even an ultra 10-year which constrains the duration to be very close to what a 10-year treasury would be. If you're interested in duration and getting duration exposure, it's the 30-year. So life insurance companies would grab the 30-year if they have they got to put money away for a long period of time, or if you simply just want maximum duration, you're buying the 30-year. Well, what's the 20-year good for? 20-year is not good for risk management, and if I'm buying duration, why not buy the 30? Why buy the 20? So it ends up with a higher yield, which to me seems like it's almost an opportunity that, yeah, why not just grab this higher yield, this kink in the curve right here? It's not very liquid. It doesn't have a big clientele effect. That if you're in the risk management business, you're in the 10-year. If you're in the duration and long-term holding horizon, you're in the 30-year. The 20 just seems to be, who wants a 20? So it really is mostly a clientele effect. There just isn't a big market for it. Where do you get? Oh, I already answered that one. Find your videos covering ABR. I have moved them. So in the applied level, if you go to sector studies, in financials, I put them in financials so that there's ABR part 1, PT 1 and 2 are in there. And then later on tonight, I'll be adding the short, the video being tearing apart the short report. I know you made them some time ago. The latest searches only provide Ninja and Viceroy. Okay, is there an alternative like a book that covers industry analysis versus the course? Because CFA doesn't expand deeply like you're doing in the paid subscription. I don't think so. I haven't found one that goes into detail about each of the particular industries. Now, there are books on industry analysis. I think the most common one that most people refer to is Michael Porter's Competitive Strategy, where he outlines how you would go through an industry analysis by looking at the power structure in the industry. buyer power, supplier power, concentration, rivalry, entry barriers, things like that, and that's how you would evaluate the attractiveness of an industry. But certainly doesn't begin to describe, well, hang on, every industry is structured differently. Here's how the mining industry works. Here's how oil and gas works. Here's how pharmaceuticals works. Here's how semiconductors are structured. That's very specific. No, I don't think, I've not seen one book that has discussions of that, which is why I'm doing them, because it seems like a big hole missing in the market. What's the best alternative to a Bloomberg terminal that has all the data needed to manage money appropriately? Well, manage money for what? Equities? You don't need a Bloomberg terminal to manage money appropriately. You just need a broker that is as close to a prime broker as possible. That means that they offer everything on the same platform, and that you can buy your services or overlay services on the platform, and they do all your reporting for you. Interactive Broker serves that function quite well, and I can trade any security in any market I want, and more as time goes by, more and more bonds, even corporate bonds, you can trade right through the system. And then any data you need. Bloomberg is just an aggregator, by the way. I mean, it aggregates all the data from other sources. If you're fixed income, going to be in fixed income, then yeah, at that point, I'd say you probably want that terminal if you're going to be trading fixed income. But equities, they offer no advantage on equities that you yourself can't get with the investor relations department of the site that you're on. You can subscribe there. You create your own news feed from the company. It has presentations. It has all the SEC filings. It has the conference calls, everything, all the data you can get without having to pay 30 grand a year US for a Bloomberg subscription. Commenting your point of view of the PE forward mismatch between the expectations of the market and the denominator. Again, yeah, you'd be either a PE is a ratio for relative analysis. So you're just comparing it over time. If you're trying to say, well, based on where the yield curve is going to be, then you want to look at the earnings yield versus where the current yields are on bonds. XLK QQQ, apart from concentration risk, any other risks for XLK? I don't know. Big overlap with XLK and QQQ. Do you think XLK is a better candidate for long-term DCA? What's DCA? Capital appreciation? Delightful capital yeah, that's it. Delightful capital appreciation. I don't know what DCA is compared to QQQ if you want tech exposure. I don't know. I don't know. I haven't done any analysis on those two over any period of time to see which is a better performer. I don't know. I would say the correlation would be really high. QQQ has 100 holdings. XLK has, fewer. So you're more diversified in QQQ, and I believe you'd have a lower management fee in QQQ versus XLK. But I believe the dividend yield on XLK is higher than QQQ. I think copper price moved to 377. Actually, it's gone even higher than that now, in the 380s, right? What's your view on this increase? What factors might be causing this? Anytime longer yields drop, it starts to make CapEx look more attractive, and almost all CapEx is going to have, anything physical you're building is going to have anything electrical in it is going to need electrons running on something, which is always copper. On MBS spread, why are you comparing 30-year FRM versus the 10-year U.S. Treasury? Because it is a spread that's that has a time series. right? So you can look at the spread, the 30-year FRM. These are amortizing mortgages that also have prepayments. So it works out that the duration of a 30-year fixed rate mortgage, the sensitivity to interest rates, is very close to what it is on a 10-year treasury, which is why the 10-year treasury is used for risk management against that. And not the current coupon on the MBS yield versus the 10-year. Well, what MBS am I looking at? Right? There's one 10-year treasury, and there's one constant fixed rate mortgage. If you're looking at Freddie and using that one, you have two things that are the same every week that you're looking at it. But for MBS, which one am I using? There are different MBSs. So it would be, and from week to week, do I have a constant MBS to look at, or is what I'm looking at 1 week younger? So if I took a bond, a 10-year, I can always look at what the constant maturity 10-year yield is. And I can always look at what a current 30-year fixed rate mortgage rate would be today at this moment. But can I get that done for an MBS? Can I find an exact 30-year? Well, you're not going to find that. Let's say it is 30-year. Can I find a 30-year MBS today? I have to wait till they're issued. Can I find a constant maturity MBS? I don't know anybody who does that. So it's just harder to have a consistent comparison. Not only that, the MBS yields, unless you have some kind of access to information, they're not that easy to find on a timely basis. Is it simply because of lack of free available info? That's one. Are both 30-year and current coupon so highly correlated? It's not that they're highly correlated, it's just that they're consistent. Each time I look at them, it is a 30-year fix starting today, and it's a 10-year treasury starting today. But the bond, the 30-year MBS, might be a 29-year and 2-month MBS until other 30 years are issued. So, and then next week, is there a 30-year issued, or am I looking at a bond that's a week younger? So the time is not the same. Update on the Theta portfolio. You started in the applied series. I didn't keep that up because it is a lot of work to do. It was enough to get it started and show you how to do this. The danger in doing it is copying, if I did it every week, copying my positions. And when I'm showing something, I'm not too concerned about what stock I'm using to do it on, just showing you how you would set it up. All the work in a Theta portfolio, all the work goes in identifying the right underlying. So out of every 20 stocks you look at, one or two might qualify. There's one or two that you might say, okay, I don't mind these. I have a very short list of ones that I would use. Oxy, love doing that. Freeport, Copex, those ones I find enjoyable. GM was a good one for a long period of time, but no more. When I say a long period of time, over the last year up to July or August, the prior year was good for it because it traded in a nice range. But I wouldn't touch it now. So all the time is spent on finding the right underlying. Once you have the right underlying and that you followed for a while and that you know and that you're comfortable with, then I don't know that I need to keep showing you how to do it. Once you know how to do it, you know how to do it. So I didn't bother keeping it up because, again, once it's done, it's done. Much like the carry trade. Open the carry trade on the yen and close the carry trade. I'm not reopening another carry trade. This is, I'll show you how to do certain things, but I don't know that my intention is to keep them up because it is a lot of work on top of everything else that I do. Why would they want to keep real rates lower, and why does that lead to monetary policy being too restrictive? Well, because interest rates, nominal interest rates, don't matter if inflation is high, right? So let's say that interest rates are, let's say I'm doing discounted cash flow, and I have a whole bunch of cash flows. These are cash flows coming in, and I'm going to discount each of these cash flows to the present, right? So let's say that these interest rates are very high, but that inflation is high, so this cash flow will grow at the rate of inflation. Well, if I can grow my prices by more than what the interest rate is, well then, who cares? Who cares if interest rates are high if I know that my prices will increase by a greater amount? So normally when you're doing cash flow forecasting is you'll forecast real cash flows. Real cash flows are only about volume. This is volume times price, or let's say quantity times price, right? So it'll just be quantity. So I think quantities will grow like this, right? Well, if I'm using just quantity, then I want to use real interest rates. So the higher real interest rates are, the more, the lower the present value of those cash flows will be. And at higher interest rates, my quantities are probably lower. If we look at any company's 10Q, they usually break down last year's earnings will be a bar like this, and then they'll have 5 or 6 things to get to this year's earnings. And they'll show you how they got there. This one here will be price changes. This one here will be volume changes. And this is what you're seeing, is that volume or quantity adds very little, that most of the difference between the net income year over year has been price change. Then there might be currency changes which took away some money. Then there might be some impairments which took away some money, and then that's how you get to this year's earnings. The price makes up a big difference. Well, the more that price could make up the difference, the less concerned you are with high nominal interest rates. You have to be concerned with high real rates. If you are bullish about a stock, would it be wise to sell short-dated in-the-money put and buy long-dated out-of-the-money call instead of using a leveraged synthetic? Well, either one of them are okay. I imagine. I'd be careful with the in-the-money put. You don't want it put to you earlier than you would want to. Yeah, you can do that. ABR yielding 13%, sits at just 1 times tangible book value. What's the catch with ABR, and why aren't investors flocking into the stock? Well, there's fear that the interest rate environment is going to cause ABR to have a whole bunch of credit losses, which is showing sort of a general lack of understanding of how the CLO works, what the consolidated balance sheet means. Keep in mind, a lot of that debt on Arbor's balance sheet isn't Arbor's debt. It's the CLO's debt. But because Arbor has an equity interest in the CLO, it has to consolidate. So we look at the debt, $7 billion in CLO debt. Yeah, but there are bondholders for those. Those are just consolidated. So there's a lack of understanding of how the CLO works. There's a lack of understanding about the business model that Arbor is under, and a mismatch in terms of the metrics that are being used to assess the portfolio versus what the portfolio is. That's the problem. A couple of weeks ago, you mentioned making a video about Costa Rica. Oh, yeah, once I get to Costa Rica, I'll do it down there. I've already made a whole bunch of notes about it, but I keep learning new things every day. Like, I wish I would have known that. And I wish I would have known this. So yeah, it's the story you have on the first day you think about moving is not the story you have on the day you move. You say, okay, well, hang on a second, I didn't know these things. So still, the benefits outweigh the negatives, but you learn about the negatives, and I will lay them all out. What are your thoughts on the impact of the new Argentina's president proposing to use the U.S. as its official currency? How will it affect the dollar? Well, it'd just be more demand for dollars, right? How can I track the Fed funds futures? CME. Just Google Fed. For CME, Google Stir Analytics, STIR Analytics, or go to CME, the CME site, and in the little search bar at the top, type in STR Analytics. You'll get a little box up, and there'll be a little menu system on the side. Over here you'll see Fed Funds Futures. Click on that, and then you'll get the chart up of the Fed Funds Futures. What do you think about the current price of COPX? Do you see any upside for the next 6 months? 6 months, I don't know. I don't know what's going to happen in the next 6 months. I think copper is a multi-year play, not just a 6-month play, but multi-year play. Why use operating earnings for SPY and not EPS? Well, because the EPS will have a whole bunch of one-time things in it that you simply can't predict, that you really don't know what they're going to be. So EPS ends up having, everything from operations, and then, we have this other stuff that shows up below the line, below the operating earnings. So being that you can only predict operating earnings and that it is the earnings from operations, that's what we start with. Anything below that usually is one-off. In an interview with Bloomberg, Larry Summers says he believes the odds of recession are only 25%. Is he wrong? You can't answer if he's wrong. If I say that it's going to rain on May 1st, which is 6 months from now, you cannot say, no, you're wrong. Only May 1st can tell me if I'm wrong. So he says 25% odds of a recession. You can agree or disagree, but you can't say he's wrong until we actually get somewhere. And if we don't have a recession, you could say, well, he was probably right, because he was predicting 75% chance of not having a recession. And if we do have a recession, we could say, well, maybe he wasn't right, because we did have a recession. The probability seemed to be greater than 25%. But just because we have a recession does not mean he was not right, because it could have been a 25% probability, and it just so happened that that's what we got. So when you make a prediction about a probability of something, and either it shows up or it doesn't, it's almost impossible to say whether you're right or wrong. So it's a great way to make a forecast. It's a 20% chance it's going to rain on May 1st. Now, if it rains on May 1st, I'll say, well, there was a 20% chance. If it doesn't, I'll say, there was an 80% chance it wouldn't. I'm going to be right no matter what. So you can't say that he's wrong. Anybody who makes a prediction, you can disagree or agree with the prediction, but you can't say they're wrong. Only time can tell if they're right or wrong. Can you make a video where you go through the ABR report by Viceroy? Already doing that. But I'm not doing Viceroy. I'm doing another short report, and then I'll touch on Viceroy a bit. But once we go through the more intelligent short report, you will have enough information such that when you start reading the Viceroy report, it will be so glaringly obvious that these people have no idea what they're talking about. Maybe Buffett sold November 15th. I don't think so. Libertarian recently won the election in Argentina. Do you think his plan to dollarize the economy and cut spending down to the bone will work to turn around that? Well, you know what? Nothing else has worked. It may as well try something, right? I mean, what if it doesn't work? Oh, well, can't be any worse than what it is now, right? Staring at a computer screen for 10 hours a day. Problems and academic formulas. Man, this gives me crippling depression. This whole financial analyst thing might not be for me. Not staring at a computer screen for 10 hours a day. You don't have to stare at a computer screen. I mean, it is the world we live in, where most of anything we want to read is delivered to us on a screen somewhere as opposed to on paper. But you can download any report and print it and look at it on paper if you want. But I get it. It's not for everyone. I get it. I mean, if you're not turned on by the content, then yeah, the screen is the thing that starts to bother you. So I'm staring at the screen. Whereas if you were turned on by the content, the screen is just something that's there. It's in the background, right? That it is bothering you means that you're not engaged with what's on the screen. No end to the delusion of Musk's fans, particularly on the retail front. Investors appear willing to support Musk and Tesla no matter what. Anecdotally, I saw a Tesla YouTuber indicating that the same pictures you showed last week look great. Well, everything's bullish. So I have come to realize that when you short Tesla, or anyone who has been shorting Tesla, I think Jim Chanos got really upset with all the Tesla fans recently as well. He's closed his short fund and particularly had some venom to spew at Tesla fans, calling them, deluded, or all the words that he used. I've come to realize that you're not shorting a stock, you're shorting a religion, and that's not going to work out. It is a religion. I've not seen this ever, even when Steve Jobs came back to Apple, and you throughout all of it you had the Apple faithful, who would consider the Apple event in San Francisco to be a pilgrimage, a rite of passage. It was a religion for them. Even Apple didn't trade at these multiples, didn't get anywhere near these multiples. And we think Steve Jobs is the most visionary CEO ever in terms of what he's created. But nowhere, even though there was a cult around him, it never had these valuations. I can remember, even with Steve Jobs there, that once you controlled for cash, Apple was seriously undervalued, almost all the time seriously undervalued. But this Tesla is beyond a stock. It is a religion. I mean, it has its own. I think there's one on Apple News. There's like Tesla News. I mean, it has its own news. It has its own YouTube. Like there are people who on YouTube who are just tell you Tesla news. There are fan clubs. All that's missing is a church that they can go pray to, or a Sunday sermon or something. But you are shorting a religion at this point. Where can I find the forward 4-quarter operating earnings you make reference to? I already answered that. In the description box, all the links are there. ABR went dividend should explain the drop. Not really. The price drop you saw that day was from the opening price, which would have been ex-dividend. Less Tesla speculation would be nice. Mark seems to hold a personal grudge against his founder. No, I have no grudge against the founder. In fact, I have no grudge. I just have a disbelief about the investors. I have no problem with the founder. Actually, the founder were two guys that Elon Musk bought Tesla from. So he's not really the founder. He may be the founder of the company, but he's, the car already existed. No, I have no problem with that. It's just the investor base and their absolute willingness to continue to believe what appear to be just blatant lies. I don't know that so much that Elon thinks he's lying, but when you keep promising something again and again and again and again and it never shows up, at some point you got to say, look, what am I doing here? Yeah, I've been asked to not say things about different things in the past. Like, can you please pass on the oil and copper analysis? Can you please pass on the corn and soy analysis? A little less on the currency analysis, please. That if I sort of just crossed everything off that I was asked less and less for, I wouldn't have anything to say. But maybe that's the goal. I don't know. It's hard to avoid Tesla because it's always right there. I mean, it's always right there. And with now his calls for his removal as CEO, and just as many on the other side saying, no, we can live with this. It's hard to not bring it up when it's right there. And, there is among the Tesla faithful a belief that this is changing the whole world. It's changing a whole industry. That it's hard to not say something about it. I believe in the past you were taking from the S&P spreadsheet. Now you take the current 2024 E. Now you take 233. I take the forward 4 quarters, not the next 12 months, but the forward not the next fiscal year, but the forward 4 months. So being that we have just seen Q3 earnings, the forward 4 quarters is the last quarter of 23 and the first 3 quarters of 2024, not all of 2024. How's the housing market in Canada? Slow. Wondering if your house sold yet? Nope. 2 showings, and that was it. Remember you speaking about a neighbor selling way. Well, now it has dropped way below original, but it's still not sold. There's just no activity in Canada. My listing is a short listing, and it simply wears off. I have no plans on cutting my price. It's already what I think a low price. And when the listing ends, it ends. It just ends. It comes off the market, and that's it. And I'll hold it. I'll hold it as a real asset, as an investment. I'm not in a position where I need to sell it. So the other guy is UBS 10 rate cuts. Well, yeah. Unless you get a recession, unless something breaks, then it won't be out of bounds. But that's probably a conditional forecast, conditional on a recession showing up sometime in Q1 or Q2. Would buying leaps on TLT be a good idea at this stage? Well, options are priced around the forward price, and with interest rates this high, the forward price is much higher. So a 50 delta, like the leaps would be expensive, period. They would just be expensive. We expect rate cuts next year. Yeah, I mean, it would probably rise by more than the forward price already has in place, but you'd do a lot better just owning TLT as opposed to buying the leap, I think. And that's it.